Welcome to the July installment of Michigan First's virtual series on credit awareness. Hope everybody's enjoying their summer and that you were able to get through the storms that ran through yesterday without too many challenges. My name is Jeff Fitrzyk, Chief Lending Officer for the Credit Union, and we are excited to have all of you on for this important event. For those of you that have been members with us for a while, hopefully you've had the opportunity to attend one or more of our credit awareness in-person seminars or some of the credit webinars that we've been hosting over the last year or so. In the in-person events, we typically spend about 2 to 3 hours talking about credit scores and how to effectively manage your credit so that when you need to borrow, you have the best chance to get the best rate that you can. This installment of our quarterly webinar series on credit awareness and management will unveil the secrets to managing a stellar credit score, empowering you to take control of your credit journey. As always, we are fortunate to have with us today the person that I truly consider to be the preeminent expert in the industry, certainly more so than anybody in this area. He's the underwriting manager for the credit union, Mr. Noel. Brock's been with the team for about 15 years and has worked in the financial industry for over 20. And he educates not only our team, but many of our members on how to best manage through credit and financial challenges to ensure that the cost of borrowing for our members remains affordable long-term. Before we get started, just a couple of quick notes. The chat feature within the presentations platform will be your opportunity to present questions to us, as no real-time audible questions will be taken. We have everyone muted and videos disabled. So please direct message Jamie Baker or myself, Jeff Fitrzyk, with questions you have that you wish to be addressed, and we'll get to those near the end of the presentation. It should last about 40 minutes today, and then we'll take some time to review and answer the questions that you've presented so that we can end no later than 1 o'clock. And so with that, I'll pass it on over to Brock to begin. Thanks, Brock.
Thanks, Jeff, and welcome everybody. Certainly want to thank you for taking time out of your busy schedules to be with us. Like Jeff said, we'll talk for about 35, 40 minutes today with time for questions at the end. But hopefully we'll give you a lot of good information that'll help you think about your credit, think about how to improve your credit, and give you some advice in that manner. And if you have any particular questions, feel free to put them out there. We'll take as much time as needed to answer those. If it's more personal to you, we are always open for you to come into one of our locations and talk to us as well. It's something that we take pride in. It's something that we're very passionate about. Michigan First Credit Union used to be Detroit Teachers Credit Union. So we are all about education. We want to educate our members on all aspects of their finances. But credit is something that we take very seriously. Something that we want to arm our members with the knowledge to make sure that their credit can be elevated as much as possible, because it really makes a difference in your pocketbooks. Your credit score affects all aspects of your life when it comes to borrowing money. And if you have a higher credit score, you're going to pay less money when you borrow. And most of us, unless we're really lucky, do have to end up borrowing from time to time. With all of that said, today, we're going to take a look at the different aspects of what makes up a credit score and how each of those aspects affect your score. So before we are done today, the objectives that we want to accomplish, that we want to arm you with, is to let you know what factors affect your credit score and how much each of those factors does affect your score. And we're going to go over some do's and don'ts for each of those factors. That way we can give some good examples, some real life examples, so you can kind of match it up with something that may be going on in your life. So let's get started. And this is a nice pie graph showing you what encompasses your credit score and what percent each of those affects your score. A lot of our members and a lot of the members that I've talked to over the years, this is foreign to them. They know, I think most people know, you want to pay your bills on time and that will help your credit score. But a lot of the other factors that are involved, many don't know about. Let's face it, this isn't something that we learned in school. When we were going through school, middle school and high school, unfortunately, they don't go over these things. And now many of us that are in the industry wish that they would. That way, a lot of us, myself included, didn't have such a bumpy start when we started borrowing money early in our lives. So this is a good way for us to go over this with you and let you know this information so you can start maybe making some adjustments in your life and help improve your credit score. So there's 5 areas that affect your credit score. The biggest one, obviously, is your payment history, how well you pay. One that is almost equally as important, though, and the one that we're probably going to spend the most time today talking about, is credit capacity. As you can see, it's just 5% lower for affecting your credit score than payment history. All right. And there's 3 other pieces of the pie. They're smaller, but they still go into your credit score. There's your length of credit, recent debt accumulation, and a mix of credit. So we're going to take some time today to go over every piece of this pie and let you know how these affect your credit scores and some do's and don'ts for each one of these. So let's start with the big one, your payment history. This is the most common one that everybody knows. You want to pay your bills on time. And we know from doing this a while, and just personal lives as well, life throws you monkey wrenches sometimes, right? And there's going to be some bumps in the road. Every once in a while, you might have a late on one of your loans that's reporting to the credit bureaus. So there's some things to talk about with those. How long do they affect your score? How much do they affect your score? So let's dig into that a little bit. Not all late payments are created equal. So if you have one that's recent, it is going to affect your credit score more, and it will affect your credit score less and less as it ages out. All right. So that's a good thing to know, though. It's not the end of the world if you have a late payment on your credit report. Is it going to affect your score? Absolutely. The nice thing is, though, the further that you get away from that, the less and less it's going to affect your score. So we do want to try to pay these on time, though. But if we do have an oopsie, now we can see how long are these going to affect me. So for the past 12 months, it's a pretty big number, 40%. Okay. As we age that out and we get to 13 to 24 months, it's going to affect your score a little bit less. We can see that's down to 30%. And if we go even longer than that, 25 months to 36 months, it's 20%. And if it's older than 3 years, it's still going to affect your score up to 10%. All right. So unfortunately, late payments do affect your score for quite a while. But the nice thing, again, if we want to think about it in a positive manner, is as we go back in time and it gets older and older, it's going to affect your score less. So what are some do's and don'ts with your payment history? One thing you want to do is try to pay your bills on time. That's the big obvious one. But it's really important to know that this is the biggest piece of the pie. So if you have to adjust your lifestyle in some way where you can avoid paying late on your mortgage, on your car payment, on your credit cards and whatnot, if you can do something else in your life to get those funds to make that payment, try to do that as much as possible, because this is the biggest piece of the pie. So try to get those bills paid on time. Another thing is double check the status of your bills. That's something that you always want to do. You can get a free copy of your credit report every year. You want to stay on top of these things to make sure that they're reporting you paid if you did. It's very, or I should say, it's a lot easier in this day and age to keep track of this stuff, because most companies that you're going to borrow through, Michigan First included, you can get on online banking and check the status of your loans. You can make sure if you made that payment that it actually went through. That's something that you always want to do, just to make sure there isn't a glitch somewhere and your payment didn't go through. That's one of the most common things that we see with our members when we ask them, hey, what happened with this payment? You were late a few months ago. One of the most common things that I hear, one of the most common things that we hear is, well, there was a glitch. I thought it was an automatic payment and it didn't go through. Double check those, because it's going to be too late by the time it happens if it is a late payment. Another thing is, and this is something that not a lot of people will tell you, but you have to learn from your past mistakes, or you have to learn from your past experiences if it wasn't a mistake. Like I said before, bad stuff happens to good people all of the time. There's going to be moments in your life where you're going through a rough time. Life is an ebb and flow. You're up and down. You're riding that wave, right? Well, if you get to a low point and you do have some late payments, learn from that experience so you don't have to go through that again. If you learn anything from that, it's that you should do everything that you can to make sure that you make your payments on time. So learn from the experiences and try to not replicate that in the future. Because like we said, the further that you get away from that late payment, the less and less it's going to affect your score. So you do have time to rebound in the future. Some things that you shouldn't do is let small collections linger, right? There has been some legislation that's been passed recently regarding medical collections, where some of those aren't going to be reporting to the credit bureaus anymore. That was a big win for us consumers. But one common thing that we see here when we're pulling up our members' credit reports and we look at tons and tons per day is little small collections, whether they be from utility companies like DTE, whether they be from other utilities like your cable, Wow Cable, AT&T, the dreaded Comcast collection, okay? Collection amounts don't matter. If you have a $100 collection from Comcast, it's going to affect your credit score just as much as a $1,000 collection from someone else. All that matters to your credit score is that there's a collection on your credit report, and it can drastically drop your credit score. And we want to avoid that. So sometimes I'll talk to members and out of pride, and I totally get it, they say, I returned my equipment to Comcast. I don't know why they're showing that as a collection. I'm never going to pay that. And while I can appreciate the principle behind that, one thing that I try to tell our members is, look, it might be time to bite the bullet and just go ahead and pay this because it's dragging your credit score down. And if they keep trying to collect on that collection, it can go on and on and on. And then they'll stop trying to collect on it. They'll sell it to another collection agency, and they're going to start to try to collect on it. So I've seen little small collections, $100, $200, that have been hanging around on our members' credit report since 2015, 2016. And when I talk to the members about it, again, it's that conversation, I don't have to pay that. That was never mine. And it's that conversation, well, maybe you should, because it's affecting your score now just as much as it was back in 2015 and 2016. As long as the last delinquency date on that collection is this month or last month, it's dinging your credit score just as bad as it was way back in the day. Okay, don't let those things linger, because if you have a collection on there, you're never going to get up to that level where you want to be, that an A+ credit that you hear talked about. And you want to be up there. You want your score to be as high as possible. That way you can get the best rate out there. So don't let those small ones linger. It's one of the most common things that I'll see with our members that just keeps hurting them and hurting them month after month. Another thing that you want to try to look out for and be as highly educated as possible about is working with credit repair companies, because there's a lot of bad players out in the market. A lot of these companies will sell you that they have your best interest at heart. And the way that most of them work is they're going to tell you, give us your money and we're going to negotiate settlements with all of your creditors. And they will. That's part of the program. But what happens is they're going to take your money every month. They're just going to keep taking your money and taking your money, but they're going to let all of your credit get behind. They have to let it get behind. And the reason that they have to let your payments get behind is they can't negotiate with those creditors until your loan is delinquent, because no creditor is going to, in faith, negotiate with someone if the bills are on time. Okay, so they're going to let you go further and further and further behind until it's almost your debts are almost charged off. At that point in time, you can probably imagine what's happened to your credit score. It's gone down as low as it can almost go. There is a way to get out of that, but it's going to take you a long time to recover from that. So you want to avoid these companies at all possible. If you are having some trouble with paying your bills on time, the best route is to contact those creditors and see if you can work with them. But the credit repair companies are going to take your money and let your debts charge off and then try to settle for a lower amount than that, which in the end could potentially mean you pay less than what you owe. But what's the damage that's been done in between that time? Now you've settled all your debts. Maybe you paid them all off. but now you can't borrow from anybody else because your score's down in the 400s or 500s. And that's not where you want to be, because even if you do get approved for a loan down there, your interest rate's going to be 20% or higher. And nobody wants to pay that much money in interest. Trust me, you're going to be paying way more money than you need to for whatever product you're borrowing for. Okay, so those are some do's and some don'ts regarding your payment history. Okay, so the next biggest piece of the pie, and the one that we want to spend a lot of time talking about, is credit capacity. Working on your credit capacity is the quickest way to have your credit score rebound. If you're having a capacity issue, this is something that you can resolve and potentially get your credit score to jump up significantly in a month's time. You get a quick rebound if you can help your capacity. Before we get into capacity, though, we need to know what loans on your credit report affect your capacity. Revolving debt is what affects your capacity. So what is revolving debt? Revolving debt are those loans that you have where you can borrow money against it and then pay it down and then keep borrowing against it. So for instance, credit cards are a good example of this. You have a credit limit for your credit card, right? So you can borrow up to a certain amount. Once you pay that down, you can borrow it back again. Those are revolving lines that are on your credit report. And this is the type of loan that affects your credit capacity. Now, remember, credit capacity almost affects your score as much as how well you pay. So this is another big piece of the pie that's extremely important. And it's the one that's easiest to fix. So what is credit capacity? Capacity is the ratio of your combined revolving credit balances to the combined credit limits. I know that doesn't make any sense. That's just the definition. Here's the layman's term for that. It's the percentage of revolving credit available to you, but that you're not using. Okay. So if you lumped all of your credit cards and all of your line of credits together, you have an amount that you can borrow, that you can go out and charge if you want to. Okay. How much of that you're using? That's your capacity, right? So if you have a credit card that's $1,000 and that's the only revolving credit you have on your credit report, if you're using all $1,000, you don't have any capacity. If you're not using any of that $1,000, you have 100% capacity. You have the ability to go use all of your revolving credit at that time. That helps your score, okay? So how do we calculate credit capacity? I know I just gave you a couple of examples, but let's dig into it so it makes a little bit more sense for everybody, because it is a complicated concept to understand. So here's an example. I just gave you an example that's similar to this. Let's say your credit limits are $1,000. So at any given point in time, you could go out and spend $1,000 on your credit cards or your lines of credit, okay? Let's say at this particular moment, you're using $400 of that. You went out and charged something for $400. So how do we calculate what your capacity is? So you take your credit limit and you subtract that balance and you get $600. That's how much available credit you have to go use. You could still go use $600 if you wanted to. So take that $600 and you divide it back by the credit limit, which is $1,000, and you get a percentage. This is a percentage that's going to show on your credit report, by the way. So it's going to be 60%. I used a very easy example here, but 60%. So you have 60% available to you. The higher that number is, the better your credit score is going to be. The lower that number is, it's going to hamper your credit score. So let's look at another example. Let's say you're young, you're new to borrowing, and you just went out and opened a Kohl's card for $100. Okay. Let's say while you were at Kohl's, you spent $90. So you're using 90 of that $100 already. What is your capacity? Again, we take that credit limit, $100, and we subtract your balance, $90. So you still have $10 available if you wanted to go charge something, okay? So let's take that $10, let's divide it back by the credit limit, I should say, of $100, and we get 10%. So your capacity is lower. You only have 10% available. So that's gonna hurt your score more. Now, if you went out and paid that $90 back, you'd have your full capacity and you'd be at 100%. That's going to raise your credit score. Okay. This is something that I want you to leave with, this screen right here. This is hugely important to your credit score. For every percentage point, approximately, that you gain in capacity, you gain a point on your credit score. Let me say that again. For every percentage point of capacity that you gain, you get a point on your credit score. Now, it's not 100 to 100%, but it's very close. So let's look at that example I just used of your Kohl's card. If you charge $90 and your limit's only $100, you only have 10% capacity, okay? So your score can go down 90 points because you're using 90% of your available credit. If you just in one fell swoop went out and paid that $90 off and your capacity was all the way full, your score could go up 90 points just from that $90. Now, most of us have more revolving debt than $100 that we can use, but the same principle applies. The higher your capacity is, the higher your score is going to go. This is hugely important for getting a bounce back in your credit score. So let's talk about some do's and don'ts when we're thinking about our capacity. Okay, something that you should do is always keep your balances as low as possible. Now, there's been so many false things that have been put out into the ether about your credit. One thing I always hear is you should always keep 30% of your revolving debt used, and that's just false. If you always keep 30% of your revolving credit used, you're always going to be at a capacity of 70%, okay, which is good. That's a good capacity, but you're robbing yourself of about 30 points on your credit score. If you just paid that 30% off, your score could go up potentially 30 points, right? So you want to keep your balances as low as possible. That doesn't mean that you don't ever want to use your revolving debt, because one thing that can happen, that's happened to me in the past, is if you don't use a credit card, sometimes, especially the bigger banks out there, will just close your card because you're not using it. And if you close your card, we'll talk about it in a little bit, that can affect your capacity as well. Okay, so you do want to use your revolving lines a little bit, at least, just enough to be noticed, to make sure that those companies know that you are using the cards. Okay, so do a little bit here and there. You just don't want to rack up high balances if possible, because you know it's going to affect your credit score. Another thing you can do is move your revolving debt. So if you have balances on your credit cards, if you have balances on your personal lines of credit, if you move those into a different type of loan, it could also help free up some of your capacity. So let's think about an example. Let's say if you pulled up your credit report right now, you have $10,000 in available limits to use. And let's say, unfortunately, you're using all $10,000 of that. Your capacity is at 0 right now. So you're robbing yourself of about 100 points on your credit score, okay? Not all of us would have the ability, probably most of us would not have the ability to go out and just pay $10,000 to free up all that capacity, okay? One alternate to that is to apply for a personal loan, an installment loan, to pay off all of that debt, okay? So all you're doing is moving $10,000 in revolving debt to $10,000 in an installment loan, or a personal loan, you've probably heard it called. What's the benefit to that? Well, personal loans and installment debt does not affect your capacity. So without borrowing any more money, you're just moving debt from a revolving debt to installment debt. You freed up all your capacity, right? You freed it all up. All you did was move it to a separate type of loan. Many people consider this a debt consolidation loan. That's why debt consolidation loans are a good option for people, because not only many times do you save money on a monthly basis by doing that, but you free up all your capacity. So you can see your credit score significantly increase with a debt consolidation loan. And again, all you've done is just moved around your debt. You've moved it from revolving debt to installment debt. So installment debt, if you want to get to a definition of it, is those types of loans that have a set term. You have a loan amount, you have a time frame that you pay it off, and when you pay it off, you're done with it. It's different from revolving debt, where you can use it and reuse it again. You can't do that with installment debt. Okay, so that's a very powerful way to boost your credit score. Another thing you can do to boost your capacity is raise your credit limits if possible. So in that scenario, if you have $10,000 in available credit and you're using all $10,000, let's say you called and you asked for increases on your credit limits and you got those increased up to 20,000. So instead of $10,000 in balances on $10,000 in lines of credit, now you have $10,000 owed, but you have $20,000 in available credit. What you've done right there is taken your capacity from nothing, 0, up to 50%. Okay, so you can increase your score by 50 points by doing that. And all you did was call your creditors and see if you can get an increase on your credit limits. You could do a combination of these as well. If you did both of them, you paid off some of your debt, increased your credit limits on others, all of that is helping boost your credit score. One thing that a lot of the borrowers that I talk to in my years here don't realize is you have to keep an eye on your credit report and make sure that all of your debt is reporting correctly. There are several companies out there who report your home equity line of credit to the credit bureaus as a revolving line of credit instead of a mortgage. So what that would do is potentially people take lines of credit out on their house so they can do work on their house. They're using that money. So that can affect your capacity, because if you take out a home equity line of credit for 50,000 and you do house repairs and use all 50,000 of that, and these companies report it to your credit bureaus as just regular revolving debt, that's going to affect your capacity. What they should be doing is reporting it as a mortgage. Mortgages don't affect your capacity. So if you look at your credit report and you see that some of these companies are doing that, you need to give them a call and see if they will report that as a mortgage instead of a revolving line. And sometimes they're not going to. So that might be a good time for you to call up Michigan First, see if we can refinance that for you and get it on the books with us, because we will report that as a mortgage. Another situation you may find yourself in, and there's a couple big names in the credit card industry that won't report your credit limits. Okay, so what's that do? You know, you have a credit limit of 5,000, let's say, and you're using $4,000 of that. Your capacity should be not at 0. But if they don't report what your credit limit is to the credit bureaus, it's actually, you're in the negative there. And there are companies out there that will do that. So you need to keep an eye on your credit report. You can come in and talk to us about that. We can look at it for you. You can get a free copy of your credit report from the credit bureaus as well. You just want to make sure that everybody's reporting things accurately, because these types of things will affect your capacity. And as we know now, that's a big piece of the pie, your capacity is. So make sure that those are reporting correctly. What are some things you should look to avoid when we're talking about credit capacity? This seems obvious, but one thing we just need to say is don't spend more than you have, right? We talked before, you do want to use your credit cards. You do want to use your revolving debt just to show them that you are using them. Don't get yourself into trouble though. Don't spend more than you have if possible. Spend amounts here or there within your budget, so you know at the end of the month you can go ahead and pay those balances off. Again, you want to keep those balances as low as possible so you can make sure that your credit score is as high as possible. Another thing to do is don't close your revolving debts if you can help it. As we'll talk about a little bit later as well with your length of credit, you want to keep your revolving lines open, okay? Because if you have $10,000 in available credit and you're not using any of it, your capacity is at 100%. That's great. That's going to help your score. Some members I've talked to have said, I don't want credit cards. I'm going to get myself into trouble. I don't want these open. I just went and closed all of them. If you do that, you've taken your capacity from 100% all the way down to 0 just by closing your cards, because to the credit bureaus, you're not going to have any available credit now. Okay. And that can affect your score. Your score could drop 100 points just by doing that. So if you are nervous about using those cards, which some people are, put them on ice, lock them in a safe, make sure they're not available to you when you go out. That's a better option than closing them when we're talking about your credit score. And again, we talked about earlier, use your cards a little bit so they know they're there. Don't find yourself in a situation where you don't use a card and the company closes it on you. Another thing is, don't get discouraged if you need to use your credit cards. These do's and don'ts that we're talking about are hard to do sometimes because life throws, situations at you that you're not prepared for. If you blow a tire on the freeway, some of us don't have $200 or $300 lying around to just go buy a new tire. Car repairs happen. It is what it is, especially here in Michigan. We're dodging potholes all over the place, right? So if you hit a pothole and you got to pay $500-$600 to get your car realigned, a new tire, a new rim, sometimes you're going to have to use your cards and your revolving debt. It's just the way it is. Don't get discouraged if you have to. We're giving you some examples of ways that you can counteract that. Do a debt consolidation loan if you have to use it. So don't get discouraged if you have to use it. Stuff happens. It is what it is. Okay. All right. So that was credit capacity. That was a very important thing for us to talk about because it's something that you can easily fix, and you could have a pretty significant boost in your credit score even in a month. Okay. So that's very important, what we just talked about. Now we're going to talk some of the smaller pieces of the pie. They don't have as much effect on your score as the others, but they do have an effect on there. And these little things you can do with these pieces of the pie can also affect your score. We just want to make sure that we do some positive things here to always make sure your score is as high as possible. Length of credit is the next biggest piece of the pie. It accounts for 15% of your score. What is length of credit? Okay, it's the age of your oldest credit line. Okay, so if you went and got your credit report right now and looked at it, your oldest trade line or your oldest creditor is going to be on there. If at all possible, try to keep that open. I had a member a couple years ago who still had a Mervyn's card reporting somehow. We don't know how that happened because Mervyn's hasn't been around for a long time. And she said, I'm just going to close that out. And I told her, this has been open since the 80s. Your next card isn't open till the 90s. Don't do that because you're going to effectively shorten your length of credit. So whatever your oldest trade line is, try to keep that open for as long as you can, because the longer your credit shows that you've been borrowing, the better that's going to be for your credit score. All right. The next bullet point we're going to cover is average age of credit as well, right? If you're taking out a bunch of new credit, your average age of your credit is going to shrink, and that can affect your score in a negative way. So we want to keep those old trade lines open and make sure that that's the average is at a good point for your score. One thing to seriously remember, and this has become more common in the last few years, is that authorized users do affect your credit score. Okay. So there's a lot of parents out there that want to put their children on as authorized users of their card. That can affect your score in every way. If they charge something to that card and you are not aware of it and you're late on there, that's going to affect both of your scores. Okay. You can use this to your advantage though as well. If you're trying to help your children out and you put them on as an authorized user for a card that's been open since the 2000s or the 90s, the credit report agencies don't differentiate that. They're going to show that that card's been open for your child as well. So you can boost their credit score, certainly, by having those authorized users on there. So just be careful with the authorized users. They do count for length of credit, and they affect your capacity. They affect your payment history. Just be very careful. If you are going to put someone that you know on as an authorized user, make sure you trust them and make sure you certainly keep an eye on a monthly basis on those cards. So what are some do's and don'ts here of the length of credit? Like I said before, keep an eye on those authorized user accounts. That's something that you should be doing on a monthly basis. You don't want to wake up one day and get a collection call from that company saying you haven't paid this and you didn't even realize that you had a balance. So keep an eye on those. Again, I say this till I'm blue in my face. Don't close your older trade lines unless you really have to. I mean, if there's no choice in the matter and you have to, then you do. Again, this is 15% of your credit score, so it's not as high as the two biggest pieces of the pies, but it does play an effect. So don't close those old trade lines if possible. All right. So the last two pieces of the pie account for 10% of your score each. The first one we're going to talk about is recent debt accumulation. If you've ever dealt with Michigan First and we've talked about your credit report with you, sometimes we'll talk about escalating debt. This is the part of the pie that we're talking about. So trade lines that have opened up within the last 12 or 18 months can affect your score. If you've opened up a ton of trade lines in that time, you can see your score go down because to the credit agencies, you're taking out too much debt too fast. Okay. Similarly, and it's related to that, any voluntary inquiries that you've authorized in the past 12 months are going to affect your score as well. So if we want to put those two things in with each other, let's say you're going out and it's that time of the year almost to do back to school shopping. Okay. Let's say you go out and you're doing some back to school shopping and you go to Old Navy, you go to Kohl's, you go to the mall, to Buckle, you name it. And they all offer a discount if you open up their credit cards and you say yes to all of those. All of a sudden, you're going to have 4, 5, 6, I've seen more than that, credit pulls on your credit report and 4, 5, and 6 new credit cards on your credit report. Your score is going to significantly go down. It's about 5 points for every voluntary credit pull that you have. So just imagine that amplified larger and larger, plus new trade lines all thrown on top of each other. You can see your score drop. And that's something that you want to avoid. So be careful with going credit crazy and opening up a bunch of new trade lines, opening or having a bunch of voluntary credit pulls on your credit report. Okay. One safeguard on this that the credit agencies have thrown out there that you can be at ease about is when you're shopping for a car or when you're shopping for a mortgage. If you go to a car dealer and you try to get financing through the car dealer, they're going to shop your information out to all the banks that they do business with, banks and credit unions. So you may go in for a car, think you only applied once, and you pull up your credit report and you see that you have 10 to 12 new credit pulls on your credit report. And you might freak out because you think you're going to get dinged 5 points for every one of those. You're not. All those count as one inquiry. Okay. And it's the same thing when you shop around for a mortgage, which you should do. You want to get the best rate that you can. You want to do business with someone you feel comfortable with and treats you the right way as well, just almost as importantly as the rate. So if you shop around to a few mortgage companies, you're going to see a few different credit pulls on there as well. Those will only count as 1, 2. So you're safeguarded for those shopping experiences. You are not safeguarded for just going out and trying to open up a bunch of credit cards or getting a bunch of other personal loans. You want to be careful with how much you do that. This is a smaller piece of the pie, but you can see your score go down significantly. All right, so what are some do's and don'ts? Be selective with those voluntary credit pulls. Before you have somebody pull your credit, a hard pull, you want to make sure it's something that you want to move forward with. You want to make sure it's something that you need and not just shopping around to a bunch of different places for credit cards and personal loans. So be selective with that. Don't go crazy. One thing that I've also seen throughout my years here is that when someone buys a home, one of our members, they will go out and then the next month, if we take a look at their credit report for any type of loan, what I'll see is a new Lowe's card, a new Home Depot card, Ashley Furniture card, Gardner White card, a new home improvement loan. Yes, I know when you buy a new home, you have all these hopes and dreams. When you're walking through that home, you say, yes, I love this home, but I want to make it my own. HGTV has made us all this way where we want to do all these projects and make it look nice, which is good. You should do that, but take your time with that, because if you go out and you overdo it after you buy a home, you're going to see your score go down. All right. So just be careful. And that goes for any going credit crazy, like we talked about. If you go back to school shopping or whatever, just be careful, be selective, be careful, because you don't want your score to go down. So the last piece of the pie is your mix of credit. So having a nice, healthy mix of credit will also help your credit score. All right. So if you only have credit cards and that's the only thing that you have on your credit report, you're going to have a hard time getting up to the higher echelon of credit scores. Okay. If you start mixing that up, if you start with some installment loans like a car loan, a boat loan, motorcycle loan, a personal loan. That's going to start to diversify your credit report, and it's going to start helping your score. And as you go on, if you start getting mortgages involved, now you're really getting a nice healthy mix of credit, and that's going to help boost your score. So this is one thing you need to be a little bit patient on. But it's something that can certainly affect your score. If you want to get up to that 800 plus range, this is something that you need to do a good job on. So what are some do's and don'ts here with mix of credit? Like I just said, one thing you need to do is be patient. I know when you first start borrowing, if you're young and you're just starting out, you can't get everything at once, right? You're not going to just start out and get approved for a huge mortgage. Most of us aren't that lucky. Most of us, it takes a little bit of time to live life before we can get to that level. So you have to be a little bit patient when it comes to this one. One thing that also is involved in this that we've talked about in a couple different aspects, and as you can see, some of these bleed over into the others, is don't close those trade lines if possible. If you have a nice healthy mix of credit and you decide you want to close all your credit cards, it's going to affect your capacity. It's going to affect your age of credit. It could, and it is going to affect your mix of credit. So you could potentially see a reduction in a few of the pieces of the pie. And now we're talking about a fairly large reduction in your credit score. Okay. So those were the pieces of the pie. We've talked about a lot of things. We've went over a lot of information here. I know there's probably some questions out there, and we do want to get those answered if possible. Really appreciate you letting me ramble for so long about this. It's something that I'm very passionate about, but it's something that we live every single day, and we want to arm our members with this knowledge so you can go out, have the highest credit score possible, and save as much money as possible when you're going out and borrowing money, hopefully from Michigan First. Do we have any questions, Jeff, that have been out there, or Jamie?
Yeah, Brock, thanks. Great job as always on the presentation. We do have a few questions here. I know that everybody was given a lot of information on the importance of developing and maintaining a strong credit score. So we've got some good questions here. And the first one is, this one came early. I know that my score is low. What's the quickest way to improve it?
Well, that's a loaded question. It depends on your own personal situation, really. If you have some small collections or even some large collections, we certainly want to try to get those worked on. If you have capacity issues, getting a debt consolidation loan would certainly help with that. The best advice I can give for anybody who asks that question is come into Michigan First and see one of our representatives. You're going to get the best advice that you can get from people who don't have any interest in seeing you get in a better situation, like a debt consolidation company. Your best interest is in our best interest, because if you're doing the right things, you're going to be able to continue to do business. And so the best way in a general question like that is to just come in and talk to one of our representatives. They're going to give you personalized attention. You're going to get personalized advice instead of general advice, and you'll know exactly how to attack those situations and get your score higher. And one thing I would say, and I say this to everybody, is you're never too far gone to boost your credit score. There's always things that you can do to increase your credit score. I've had countless members that have come in down in the dumps about their credit, who have been down in the 400s and 500s, that we've seen climb that credit hill, and now they were in the 600s, then they were in the 700s. Now they're getting the best rates out there. I've talked to so many members who didn't think that it was possible, and then here we are celebrating them getting a mortgage, crying together, hugging each other, watching them on that journey. It's never too late. Never too late, and there's never a credit report I've seen too far gone where we can't do something to help.
Yep, great advice, Brock. Come to a place that cares, folks, and that for sure is Michigan First. Next question. I have a lot of credit card debt. How do you determine how much someone can get on a debt consolidation loan?
Again, that's something that is personalized to you. The best thing to do is to come in and talk to somebody. One thing that we pride ourselves on here at Michigan First as well is, if you have a lot of credit card debt, sometimes we can't knock it all out in one swoop, right? Sometimes you have to start small and take baby steps to get that debt paid off, right? There's other options you can take. If you own your car free and clear and there's some value there, you can use your car as collateral to take out a larger amount. You can use your house as collateral to take out a larger amount. And if you do own your house and you have available equity, you're going to get a much better rate and much better terms to do it that way as well. Again, if you took all your credit card debt and put it onto a mortgage, your capacity is all freed up there too, because mortgages don't affect your capacity either. Okay, so that's individualized to your situation. I would just urge you to come in and talk to somebody so we can see what you can do. But even if we can't, there's been so many times as well that we weren't able to help a member right now. But what we are able to do is offer you advice on what you can do to get there. I've had several members that I've talked to over the years where we weren't able to do anything right then. I give them a plan for the next 6 months to a year, sometimes even shorter than that. This is what the plan is. This is what you need to do right now. I'm setting up a follow appointment with you to call you in that certain amount of time. We're going to look at your situation then, and maybe we can do it at that time. Okay. So everything that we do at Michigan First is individualized to our members. We try to come up with creative solutions just for you, nobody else, just for your situation, so we can put you in a better situation. So I would suggest highly coming in and talking to somebody.
All righty. Next question refers to those scenarios where you're a member who uses credit cards, but you typically purchase with them, build up debt, and then before the end of the month or your next statement cycle, you immediately pay it off. How does that help or hurt credit score?
Mostly helps. That's the same thing that I do. My family is a Disney family. So we have a Disney rewards card that we use that we put a lot of our purchases on and try to build up. Disney is expensive, so we try to put those points on there. It's a rewards card. We also use the Michigan First rewards card in my family because you can also get rewards points with that, and you can buy gift cards to places like Disney or Target or you name it. So there are a lot of individuals out there who will just charge everything on their cards, pay them off at the end of the month because they're getting rewards points for whatever they're passionate about. That's a good thing. It can affect your score a little bit, depending on how much of your balance you're using. If you're doing that on a card that only has a $500 limit and you're maxing it out every month and then paying it off, you run the risk of having that high balance when that borrower or that lending institution delivers their balances to the credit bureaus. So once a month, every creditor out there sends information over to the credit bureaus of what your balance is. So if you're at that point and you're maxed out, it could show to the credit bureaus that you're maxed out. Okay. So my suggestion for people who are in that situation is use a card that you have a high limit on, so it doesn't matter that much. For instance, if you have a credit card out there that has a $10,000 limit and you're only charging $500 on that a month and then paying it off, you're really not affecting your capacity too much, because even if it reports that $500 balance, your capacity is still going to be very low in relation to that $10,000. Okay. So use a card that has a higher limit. If you don't have a card that has a higher limit, now it's that time, like we talked about earlier, to call and see if you can get a higher limit on your cards. That way you don't run the situation of showing the credit bureaus that your capacity is zero, and so you can show them that you have a lot of available credit.
All right, great points there, Brock. And just to piggyback on what you had to say, for those of you that are in that scenario and you do that typically every month, it's always good to know when your credit card provider reports to the credit bureaus. For those of you that have a card with us, we report on the first of every month, but I know it is different from credit card provider to credit card provider. So feel free to ask so that you can plan accordingly. I got one more question here. And it is, what are the best steps I can take to establish new credit if I don't have any, or for a child who is going off to college?
That's a great question. And this is one of the loans that we have that I'm very passionate about. It doesn't really move the needle much as far as balances or how high they are, but it certainly helps anybody who's looking to establish credit. whether you are young and brand new to credit, whether you filed bankruptcy and you're trying to reestablish your credit, whatever situation that you're in, we have a loan called our shared secured loan and a shared secured credit card. And how this loan works is the minimum amount's $500. So you would come into the credit union with $500. You would put that in a savings account with us, and we would put that money on hold. In turn, we give you a $500 loan. Okay, so you're not leaving with any less money than what you walked in with. We're just holding $500 of your money versus the $500 that we give you back to walk out the door. What that's going to do is you're going to have to make payments on that $500 that we gave you. Usually it's a 6-month term. So for 6 months, you're going to pay about $90 a month, maybe $100 a month until that card is paid off or that loan is paid off. Okay, this is on the shared secured loan, not the credit card. What that's going to do in that time is all of a sudden the credit bureaus are going to see that you have a loan. You have an installment loan out there. Okay, now you're going to start to build your credit score. And if you make all those payments on time, which is crucial, that's another part of this, is making those payments on time, you're going to start to develop a positive credit score. Okay, the reason that we hold $500 is if for whatever reason during that time you don't make a payment or you decide you can't pay us back, we have a way to recoup our money because you already had our $500. Okay, this doesn't happen very often, just so you know. Most of the time, these are successful stories where our members will come in, take this loan out, make the payments on time. Okay, so there goes 6 months of positive payment history on your credit report. You're starting to build your credit. At the end of that 6 months, we don't want to just let everything fall off then, because if you don't have any credit, you're going to go back down to a 0 credit score. You're not going to have a credit score. The next step after that is let's take out another loan. Let's maybe do a $1,000 personal loan, a $500 personal loan to see if we can continue to build your credit. Okay, these are the small steps that you're taking. Well, let's say you take out $1,000. Let's say you've been paying that well for 6 months. Now as Michigan First, we can look back and say, Mr. or Mrs. Member has been paying us well for a year now. What else can we do? Maybe they take out a rewards credit card at that time. Now you're diversifying your credit. You're getting that good mix of credit. Your capacity is going to start showing up if you get a credit card. Now you're well on your way to building a credit score. So the process, it can be a little bit slower, but in the long run, it's so beneficial to do these loans. Now you can do a shared secured credit card as well. That's going to start to build capacity right off the bat. Again, you're coming in with your own money and we're holding that in account while you can go out and charge money on your shared secured credit card. So those are the two best options for building credit. They're very, very popular here at Michigan First. And I've seen so many stories over the 15 years that I've worked here of members using those products to help build their credit score or to help rebuild their credit score if needed, so they can get back on track with high credit scores.
All right, thank you, Brock, very much. It looks like we've addressed most of the questions presented, and we're almost out of time. It's now 12:53. Going forward, if anyone has any additional questions or is interested in discussing their individual credit situation with one of our credit professionals, Brock mentioned many times, please make sure to visit one of our 29 branch locations. Across the state, call 1-800-664-3828 or visit us online at michiganfirst.com. On behalf of our nearly 500 team members, we want to thank you for participating and for supporting Michigan First, of course. That's all for now. So until next time, enjoy the rest of the summer, guys. Take care.